So the team on American predatory lending is going to present first. Whenever you guys are ready, go ahead and take it away.
Yeah, so I guess I can start us off then, having done the abstract. Like mentioned, we're the American Predatory Lending Team. This is our third and final presentation. And just a brief background, what's mentioned in the abstract on what our team has done and what the kind of goal was for this team. So we split up into two sections. Right, is there a lot of background noise? I can't really, for anyone else. Yeah, thanks. So we split up into two teams at the beginning of this project, Team USA and Team North Carolina. So Team USA, which I was part of, delved into 5 additional states: Arizona, Florida, Georgia, Massachusetts, and Ohio, as outlined in the US map. And then Team North Carolina kind of delved deeper into the previous work that was done by the last Data Plus team on North Carolina and the housing bubble within it, looking at county-wide level data and racial demographics, urban versus rural data as well, which I'm sure they'll talk about later. And then what we at Team USA did was just look at the statewide level data for how the housing bubble kind of behaved and what the after effects were for, like I mentioned, Arizona, Florida, Georgia, Massachusetts, and Ohio. So 2 levels of detail being done in this project.
So first, I'll introduce the part of overview of the housing market. If we can zoom in a little bit, you can see that there are 2 visualizations here. The first about the real housing price. So by meaning real housing price, where there was a housing price that has like excluded effect of inflation, and just see like how the housing price rise compared to other like goods. But basically we see that the housing price has been remained stable in the past decades, but it rose dramatically in the years from 2000 to 2007, which we can see that the color in these visualizations are just like the ones we used in the above map. And we see that Florida and Arizona and these 2 states have the like highest and like most dramatic housing bubble in these years. And also the housing price in these states just fall down after the financial crisis to the original level, or like about the level of 2000, which more prove that this is a housing bubble. And second visualization is about home ownership rate. We see that there's a general trend that the home ownership rate start to decrease starting from 2005 and 2006 in most of these states. So this shows that some effect of the financial crisis, that it really hurts the homeowners, because in fact the default rates, like the rising default rates and also the decreasing income during financial crisis, really deprive people of their homes, especially those people who take loans that require them to pay back. And by looking more detailedly into the mortgage market, we can see the box of overview of the mortgage market. So this plot basically shows the percentage of refinancing loans as a percentage of all loans. The refinancing, by definition, it means like using a new loans to replace an existing loans. And many research shows that like the predatory lending, or the kind of abusive practices in the lending industry, a lot of these do happen in the process of refinancing, because the lenders can charge a lot of fees and prepayment penalties in the process. So we see that the refinancing percentage basically peaked in 2003, when it reached about like 70% to 80% in some states. And then it decreased a little bit in 2004 to 2005, like in these years, because as we observed, there's an increase in the federal funds rate in May 2004, which kind of lead to a cool down in the mortgage market.
So this visualization kind of depicts the delinquency rates as mentioned, but more specifically, the seriously delinquent mortgages in each state between 2000 and 2009. And as said in the description, a seriously delinquent mortgage is typically one in which a mortgage payment is 90 days or more past due. So this visualization is kind of a culmination of all of our findings about the housing bubble. As William mentioned, refinancing loans being particularly predatory. And then another thing that we found was that the rate of increase in the loan amounts being issued was far greater than the actual average applicant income for these loans. So that combined with refinancing loans and just loosening credit requirements meant that when the system started to become more shaky in 2007, 2008, we saw the housing bubble totally collapse because it was built on such shaky foundations. And when people began to be unemployed, they could no longer afford their very high-priced mortgage loans, and that led to, particularly in Arizona and Florida, which are the two highest peaks as shown, it led to delinquency rates of 20 and 12%, which was far greater than what was seen between 2000 and 2007, where it hovered around 0 to 2%. So this visualization kind of just shows the scale of delinquency and foreclosures that resulted from these predatory practices.
So as the North Carolina sub-team, our goal was to expand on the broad overview of North Carolina that last summer's Data Plus team did. So in order to do that, we divided the state into its main regions. And these regions are formed based on geographic and cultural differences. And we also realized that there's a strong distinction between rural and urban life in the state, and we wanted to capture this. So we identified the state's top 9 urban counties as counties where less than 20% of the population lives in rural areas. And we made these urban counties their own grouping because they're obviously going to behave differently from the rural counties. And so you can see a map of our region breakdown here, in addition to some broad overview statistics such as the population breakdown and the white ratio by each region. One big part of our analysis involved rate spreads. In simple terms, what a rate spread is the difference between a loan's APR, or annual percentage rate, and then an estimate of current APRs on prime mortgage loans with similar characteristics to the loan in question. And so in the absence of interest rate data, as HMDA does not, the HMDA data set, which is where we were pulling all of our information from, they don't require interest rate reporting. Instead, they require rate spread reporting. So it was a useful metric for comparing what different groups are paying for their mortgages. So one of our biggest takeaways was that Black borrowers were receiving consistently higher rate spreads than their white and Hispanic counterparts across all regions from 2004 to 2009. And rate spread recording began in 2004 with HMDA's regulation changes. So on the graph on the left, we can see across all regions in the time period, Black borrowers are receiving consistently higher rate spreads. And then in the table on the right, we controlled for income percentile. And even when doing so, we saw that Black borrowers were still receiving consistently higher rate spreads than their white counterparts.
So another aspect of the North Carolina lending market we have been very interested in exploring is the applicants' mortgage denial rates. As the left plot shows, when broken down by race and region, the minorities in black and green colors were denied far more frequently than were white applicants in North Carolina. However, because HMDA data contains little information about the applicants' credit worthiness characteristics, so we do not know whether equally qualified applicants of varying backgrounds were being treated differently. The right plot shows the top 5 denial reasons by race. So clearly, the most frequently reported reasons were weak credit history or the risk of a high degree of household indebtedness, no matter what race they are. In conclusion, we have provided a broad summary of the behavior of the mortgage markets in several states. And also we did a deeper examination of North Carolina's lending market. For future work, we recommend first, expand our analysis to more states around the country. And second, conduct a regression or other statistic models to examine the relationships between variables such as income, race, loan amount, rate spread, and denial rates, which we believe could yield more concrete conclusions with regard to the predatory lending markets. Yeah, that's it from us. Thank you.
Thanks a lot. That was great. And we have a few questions. So Omar Ali asks, is there other information that banks may have on borrowers like wealth that might explain the large rate spreads for Black borrowers?
So yeah, I can take that. There isn't, the HMDA data set unfortunately doesn't have a lot of metrics for looking at stuff like that. Like you mentioned, they don't have any information on credit score, which makes it difficult to make claims about racial targeting. But the best proxy we had was applicant income, and that's what we broke it down by in that table. We also did break it down by the riskiness of a loan, which our best proxy for that was the income to loan ratio, as intuitively, if a borrower has a high income to loan ratio, then that loan should be perceived as safer. And when breaking it down like that, we also noted that Black borrowers were receiving higher rate spreads.
So just to summarize, so even when you break things down by income, Black borrowers are still being discriminated against, is that, or having higher rates of loan rates, is that accurate?
Yes, that's what we see in this table. And then in our specific regional analysis, which we didn't have space to include on this poster, we would break it down by the income percentile and the risk group, which we created with our income to loan proxy. And in that analysis, we also noted that Black borrowers were receiving higher rate spreads on average.
And then while we're on this table, so if we also just look at like wealth groups being discriminated against or having higher loan interests, are poor people generally have higher rates or are, in terms of predation, like, so you have, there's an indication that there's predatory lending in the Black community. Is there also information that there's predatory lending in just the impoverished community in general?
Yes, I would absolutely say that the biggest factor that would contribute to higher rate spreads would be having lower income. We found a very strong relationship between income and rate spread in that way.
Great. So Kate Coulter asks, so first she says, great job. So fun to see how this project has gone just with the summer alone. The questions, biggest takeaways and surprises for the non-NC states comparisons you found. What are those? What are the biggest takeaways and surprises?
I can mention mine, and then if William wants to mention his as well, that'd be great. But I think for me personally, I talked about this a decent amount throughout the project, is how differently Massachusetts behaved compared to the other states, which I found particularly surprising. If you look at delinquency rates, for example, just on this visualization itself, Massachusetts is that light gray one right at the bottom. So their peak delinquency rate was around 7%, and it hardly increased compared to when you say, like I mentioned, Florida and Arizona peaking at 20% and 12% respectively. And just pretty much consistently throughout every visualization, Massachusetts, even when you look at house price indexes in the fall, Massachusetts seems the least affected compared to all these states. And I spent a bit of time thinking about this. And I think there's just various factors that go into it. I think Massachusetts GDP was higher than these states. The average wage is higher. The percentage of conventional loans is also higher. And then I think, just when discussing with people, I think also geographically has some way to do with how it kind of played out the way it did, in that a lot of these predatory practices were taking place just in places in Florida which were very densely populated when it came to houses, in places like Miami and Palm Beach. So I think that element of like geographic location also has something to do with it, and how densely populated the areas are. But it was just interesting to note that how consistently Massachusetts kind of behaved as the least affected and as an outlier, which I was not expecting.
And what are the next steps?
Just,
oh, go ahead. Sorry.
I mean, just adding on that, I think like a lot of these states have their like unique point of behavior that like we didn't see in other states. For example, I think Ohio looks Ohio looks kind of similar to Massachusetts in that they're kind of less affected. And Arizona looks like Florida. These two states are the most severely affected states among the the states we're looking at. And I think Georgia also kind of look like North Carolina. But I think, yeah, as Roger mentioned, there are a lot of geographic issues as well as like the population issues in these points. But I think it's worth looking at each state separately and as we dig into their unique behavior from others.
Cool. And what are some of the next steps that you see in this project, both for the NC analysis and the non-NC analysis?
I can say first. So basically right now what we have done are some EDA plots, like exploratory data analysis, which can show some patterns about the different variables, but we cannot quantify the correlation between the variables for some, the outcomes. For example, like if we want to say what kind of factors will affect the denial rates mostly, then we need to maybe do a regression or something like that to check the correlation behind them to find the real reason that affect the result most important, something like that. Yeah, that's the first point I could imagine. And you could guys, you could add other points if you come up with some ideas.
Yeah, I was going to say for the Team USA, I think the natural next step is to kind of replicate what Team North Carolina did in terms of digging a bit deeper into the specifics when it comes to like rate spreads, geographic, so urban versus rural, and then also looking more into the racial, into how like specific minority groups were affected by the housing bubble. And then also I think the plan is, I might be wrong, but I think the plan is for the Basque Connections group to do like oral interviews and collect more interviews with what actually happened with regard to like legislators and people who were just affected by the housing bubble. So I think that would also be particularly useful to like supplement all of this data analysis with, just to get like a more holistic, like complete set.
Carolyn Chen asks, are there other sources for data outside the HMDA data that you guys believe might be promising for further analysis?
I can take this question. So basically, a lot of our analysis is based on this HMDA data set, but we also use some like Federal Reserve economic data when making our visualizations. Another data set that I think is very interesting is the Freddie Mac single home loan data set. It only documents the loans from Freddie Mac, but it also has a lot of interesting information like loan to value ratio and also on the interest rate, which is not present in the HMDA data. I think maybe we can look at that data set in the future, which can also provide us also a lot of interesting information.
Cool. And so the next question is from an iPhone, it's to what extent did this conform with your intuitions for what happened and what you already knew about the 2008 crisis? And I think you may have answered this slightly with the Massachusetts anomaly already. But was there anything else that either did or did not conform to what you already knew happened in 2008?
I guess I can take this one. I mean, I would say that most of what we found aligned pretty strongly with what I'd been expecting to see coming in. I'd say one of the biggest surprises that I found was the denial rate analysis, because even with rate spreads, the differences in the averages was fairly small, and that can be very impactful on a large scale. But the discrepancy in the denial rates between Black and white applicants, I was honestly very shocked by. That's a huge factor that I hadn't really thought much about when thinking about the predatory market leading into the crisis. I thought it was more so about what interest rate they're getting, how their loan is structured. But when you're getting denied at such a higher rate than people around you, I hadn't thought about how that would impact your negotiation ability when negotiating those terms for your loan.
So Joseph Smith asks, growth rates of states, perhaps Massachusetts outlier status, may also be a result of stricter regulatory environments. Do you have any comments about that, or any knowledge about those regulatory systems?
I looked into it briefly at the beginning, and I didn't see any like tangible differences, to be honest with you, but I might not have been looking in the right place. I was mainly just looking, to be honest, with like geographic and demographic and kind of income variations that would have explained it. So like the differences in income, the difference in population density, the demographic makeup of Massachusetts and Florida. But I definitely want to look more into like the regulatory environment as well.
So there's another comment, which is very different policies and regulatory environments may be interesting to explore from a policy analysis perspective. So yeah, just a comment on that. So those are all the questions in the chat. Is there anything else that people want to bring up or comment about? It seems like you guys have oh, so you have a lot of compliments coming into the chat. Yes, very nice. Agreed. So I guess I think you've mostly already touched upon this, but I guess I just want to go back to this next steps thing. So you know, what's so.
How do you get into Facebook?
Oh, sorry. So what's the sort of the next thing? What's the next question you have in terms of trying to move forward with this project? What's the next thing you want to test or investigate? I mean, and that could be, as you already said, sort of doing the North Carolina specific analysis on other states. And I guess, you know, if you did that, what would you be looking for? Would you be looking for a pattern, similar patterns? Would you be sort of just doing data exploration at that point?
Maybe I can take that question. I think like all of our work is to try to find some evidence from the data perspective about the existence of predatory lending in like these states or like maybe even the counties, because currently in literature there are a lot of like anecdotal evidence instead of like data evidence that can support the existence of the predatory lending. So we're interested in like by analyzing the rate spread or denial rates or like all of these specific indicators to try to see whether predatory lending actually exists and like what affects it to the extent it impacts our economy.
Great.
Yeah, and just to build on that, I think Lee actually just put it in the comments, but what was mentioned about looking at like the specific policies, because a lot of the work, especially in the first few weeks of this project, was kind of filtering and sorting the data so that it was such large data sets that we could work with it efficiently and create visualizations. And maybe at the expense, or maybe we just didn't have enough time, was like reading into the policies behind this data and like what more explanations for why this data looks the way it does. So hopefully with like, in addition to what William said as well, just understanding more of the policy behind these things so that we can link them better together.
That's great. So thank you all very much. This is a really nice presentation. We can give a virtual or video round of applause to this team. We have about 5 minutes to transition over to the next group. So if if you have any other questions for this team, please feel free to put them in the chat and they can interact with you a little bit more. And